While stocks are rebounding today, our first guest sees these gains as just a brief counter trend in response to yesterday's sell-off. For more on what the latest moves mean for investors, we want to welcome in David Rosenberg, Rosenberg Research founder and president. So, David, we are bouncing today, green all over my screen. You say, though, David, this is a brief counter trend trade. How come, David?
Well, a lot of this is just purely algo trading and a oversized reaction to the oversized negative reaction that we got in the past couple of days. The market has become unhinged. In the past, not just the past few days, the past week, the volatility has been off the charts, and not just daily, but hourly. So, from my perspective, you got the VIX hitting 60 after, a monumental decline over a couple of days. And you would expect that, you would get a technical bounce off the oversold levels that we had. But to make anything over and beyond that, I think is not a wise thing to do. The market was starting to look wobbly even before what happened yesterday or Friday. And, last I looked, nice bounce today. The Dow is still off nearly 2,000 points from the high. Nice bounce today. The S&P 500 is still down about 7% from the high. So there's a lot of technical damage that was done, and technically we're reversing course right now. But this market is definitely not out of the woods.
Dave, let's also talk about the backdrop for at least one of the reasons why the sell-off has been occurring, and that's concerns about the economy. You probably just heard us saying that it seems as though the consensus is coalescing around the idea that the economy is slowing, but perhaps not into a recession. I have a feeling you're on the other side of that. So if we are either already in a recession or rapidly approaching one, what is sort of the engine of that recession, if you will, or what is the engine that is sputtering in the U.S. economy?
Well, you've got the housing market has turned down again. And even with the fall off in mortgage rates, the housing sector has started to falter in a very significant way. So that's point number one. And housing, of course, is a quintessential leading indicator. On top of that, look at the information we got on Friday from the nonfarm payrolls. We had flat factory employment, a big decline in hours worked and in overtime that transcended, what we're seeing out of the hurricane. So it looks like industrial production is starting to roll over again. But the elephant in the room, always and everywhere, is employment. And of course, that is a coincidental lagging indicator. But, when taking a look at 114,000 non-farm payrolls, of course, over half that number was the birth-death model. But in the context of the size of the labor force, that is basically insignificant. And the household survey employment is actually now running flat year over year. So you're looking at the whole gamut of employment indicators. You look at non-farm payrolls, you look at the household survey, you look at the JOLTS, look at the jobless claims, and what's happening to the backlog of continuing claims. And you could see that cracks are starting to emerge in the labor market. And that's why the stock market was selling off on Friday, why the bond market was rallying on Friday. Then, of course, we got hit with this, reversion of the yen carry trade, and that was mostly yesterday's story. But Friday's story of cracks emerging in the labor market, that hasn't gone away. And so the fact that we don't have any more fiscal stimulus, that the household savings file from the prior pandemic stimulus has run dry. And now, you talk about a cooling in the labor market, but the household survey is actually flat year over year. And in the past, going back to 1950, when you flatten out on the household survey, you're either heading into recession, already in one, or crawling out of one. So I still think that the recession is, you can argue that it's not here just yet, but I think that it's not too far away.
Let me ask you, David, what do you think the response of the Fed here is? We did have, Julie was mentioned, we had some folks, some economists saying, intermeeting cut by the Fed, not out of the question. Are you in that camp? And what do you expect in September?
No, well, look, the intermeeting move was a knee-jerk reaction to what happened on the stock market, and you can argue, I guess, in the credit market yesterday. But that was never going to happen unless the stock market continued to go into free fall, or you had a freeze up in the credit markets. They were not going to move intermeeting just based on what happened in one day with the equity market. That said, will they cut rates in September? Yes, they will. Will it be 25 or 50? Well, I think that's the debate. But remember, just like a month or two ago, everybody was debating whether the Fed would go at all in September because the November election was right around the corner. And now a September rate cut, whether it's 25 or 50, is basically baked in the cake. Now, frankly, I don't care so much about, whether they go in meeting A, B, or C. They skip a meeting, go 50 basis points at a certain meeting. To me, that's noise, I guess, that you could trade around the noise. I just know what the destination is, okay? I know that Powell gave us a ton of information at the podium last Wednesday at the press conference after the FOMC meeting, where he used the term normalization to describe the economy and the labor market no fewer than 11 times. And he had mentioned that the last time that we had normalization was in 2019, when, by the way, he cut 3 times all the way to 1.75%. He didn't have to mention 2019. He didn't have to mention any year at all. He talked about how the inflationary backdrop and the labor market is where it was in 2019. Well, 2019, the unemployment was 1.75. Here he's talking normalized 11 times, and the only that hasn't normalized is the Fed funds rate. So whether they go in a meeting or don't go in a meeting, or whether they skip a meeting between now and the end of the year, so on and so forth, by the end of this year, I think the funds rate is going to be anywhere between 175 and 275. So I'm more comfortable talking about the destination than I am about, whether they're going to go 25, 50 or in a meeting.
You said by the end of this year, Dave?
By this time next year.
Woo, I was going to say, that would be quite dramatic. Finally, I want to ask you about what all of this implies for stocks going forward. I thought Goldman Sachs had an interesting note today where they were sort of breaking down the sell-off and trying to figure out what was coming. They did point out that typically when you see a 5% pullback in the S&P 500, in the 1 month, 3 month, 6 month, 12-month period following, you tend to have positive returns. So, we've had this 5% pullback. Maybe it'll keep going. But then what do you think happens?
I don't even know what to call that. Is that called analysis? I mean, you could give that as a homework assignment to a university, to a high school student, that if the market goes down this is what happens 80% of the time. Look, the question is, as an equity investor, do you want to pay to take on equity risk or get paid to take on equity risk? And I respect something called math. In other words, the equity risk premium, the spread between the earnings yield in the stock market and the yield that you can get in the 10-year treasury note. And the equity risk premium, it has gone up during this corrective phase and bond yields coming down, but it's still around 100 basis points. Where's the long run mean? Closer to 300 basis points. So I still don't like the math. I don't like the math behind the stock market. I like to invest with tailwinds, not headwinds. And right now, if you're taking a look at risk reward attributes, actually the treasury market offers better relative value on a risk adjusted basis than the equity market does. And that's just basically, that's doing homework. That's not like, oh, you're down 5% and then you do this. I mean, that's I would never recommend anybody invest with that sort of logic. The issue here is you have a P multiple on a forward basis still flirting between 20 and 21 at a time when the 10-year treasury note is yielding you close to 4%. The stock market's just not compelling when you look at it in terms of what you can get in the risk-free rate. And that's the point that I've been trying to make, and I still make. The market's still just too expensive, and I know valuations are not a timing device, obviously. But they tell you whether or not you're investing with the wind in your face or the wind at your back, and I think that the wind is in your face right now.
We shall see, Dave. We shall see. Thank you so much for joining us. Appreciate your time.